I was just going back through my accounts and just looking at where the money has been going. Sometimes if there's a subscription that I should have stopped that keeps on taking from my account, I don't see it because I don't have the practice of going back every month and just looking at the movement of the money to know what is what. Sometimes in terms of accounts receivables, there's some money that you didn't get, and if you don't check, there can be a number of things that even goes unpaid and you don't know. So I feel like I need to go back over my last 5 years of accounting and just kind of streamline things for the last 5 years. That's how I feel. I feel like I don't want to just clean it up and move forward, but I would want some expert eyes to generate my account for the last 5 years, my accounts and financial.
Wow. So do you have records for those?
Well, because I have a business account, most things run through my business account, and anything that doesn't go through my business account goes through one other account, which is a personal account. So in terms of the bank recon, it would be only those two accounts to go through, and the other stuff are like routine expenses. So it's not hard to track.
And how many things you pay from your pocket?
Not many. Like I have some one-on-one clients that might come to me and say they had a problem with the transfer, and they give me the money in my hand. Most of the times I run it through the account, but sometimes I end up in my purse and I just buy all kind of things till it's done. But that's not often.
Okay.
So it's, but you see, when you work with companies, they always pay you via your account. So it make it not too bad if I should go and track it. And like whenever I have a staff member, I always know when they start and when they stop, and it's a fixed income per month. So even if I don't see it coming out of the bank account, I know that I would have paid it from my personal account.
Okay.
So with a conversation and I'm looking at the bank statements, it wouldn't be too hard.
Okay.
But that's not something I feel like I can do by myself. Like to go through it myself and put the stuff in QuickBooks and do it alone, I don't think we can do it. Honestly. I know my strengths.
You're going to be surprised. Watch.
I don't cringe. By the time I look when them printed out, I went to NCB, to get the 5 year statement printed out, and just looking at the stack of running lines of things and numbers, and I can't remember what some things was. Just that alone, me give up in 10 minutes and go and do my business again. Gotta make more money.
Oh boy.
I need help.
Help. When we come to coaching, we'll see. You see what you may not need as you may be able to do it on your own.
Yeah. No.
You may be able to do some things on your own. You surprise yourself.
All right. I trust you.
All right. Let me see. Are we missing? Yes, I'm not seeing Nicholas and Tanisha. Colin? 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 And Colin is busy. Give me a moment, please. All right. So while Colin finds Tanisha and Nicholas, any other comments on what we have done so far and how it is having an impact or on how you look at your business? Abby and Matthew?
Yes, Miss Karen.
Any
Miss Tanisha is gonna log in shortly, but she said she won't be able to participate.
okay. Anything on how you look at your business now? Anything you find that you even start doing different as of now?
Well, I find say I wasn't logging much information before. Like since the last cohort, me really tune into documenting not only transactions but most of the processes that come through our opportunities, you know, just to see how things play out. But when it
And
comes
your
to
agreements?
yeah, my agreements and all that kind of stuff, like when we were just coming on the scene, we were taking a lot of sacrifices by just doing things for the sake of getting our name and our image out there, you know. So as far as contracts and them thing they go, we never really focus on them more than just collect a little money and do a little work and go through. But the more things get professional now, and we realize also how the industry was taking advantage of us because we were not putting a price on we were not really securing our worth. And
Okay, because you never ever know what you're worth, eh?
right, you know, like that. Which they knew what they were getting the budgets for us to work with, but what they were offering was far, far less, you know,
So
than what to do.
you have
So
to know what your costs are and so on, so you know how to price
yeah,
it
and start
up.
put it in contract instead of just reasoning about it, and then by the time it come to payment, you're negotiating. Like no, them time they're done. So everything contracted and broken down to within time and what it costs, you know, and the different also other things that we incorporate to start charging for, like gears. Normally we just charge for the bike and the rider.
So you're underselling yourself.
Yeah, man, and all of this start coming from our last cohort, you know, make me start think, apply the accounting philosophies to a lot of other aspects of the business, you know.
Okay.
Yeah, man, for sure.
Okay.
Like I said, me as a giving person too, we tend to give away a lot and spend the money a lot and can't track for set. But we just spend this money to make this amount of things. How comes we don't make back this amount of money? You know?
Yeah.
Yeah, all of that come with, because we are creatives. But now, since the last trip, now we have to focus on the business, man. And focus on the accounting and so forth. And once you have a business, you have to pay taxes and all that kind of thing.
All right. Abby? Abby FR? Morning, Nicholas.
Good morning. I didn't realize that I had a class this morning.
Oh, yeah.
My apologies. Yes.
No problem. Morning, Tanisha. Just saying hi. I know you won't be able to
Morning,
talk.
Yeah, morning, Miss Karen. Yes, I told Colleen.
Yes, yes. Okay. All right. Hope you can listen though.
Yes, will do.
Okay. All right. So, Nicholas, is there anything that we would have said in the past two classes that caused you to stop and take a look at your business practices and, see where there may have been waste or where you have lost track of what you're doing in terms of your accounts?
Yes, there are many things that I see that I am looking into, as well as changing the business from a sole proprietor to a limited liability. Currently doing that right now, as well as I am opening an office as well. So I have a lot of things going on.
And you know that opening the limited liability company is going to require that your accounts are done timely because they have to be filed as a limited liability company.
Definitely.
All right. Okay, great. Abiathar?
Yes, miss. Good morning, everyone. So what I have stopped to think about is to gather back my old receipt books, as I have a lot of old receipt books that I would have put away in barrels and so on and so forth. I have taken them out and I'm trying to get them electronically saved right now. I've also stopped to think about our contracts with our suppliers and our terms of agreements and so on and so forth. We have also stopped to think about the pre-planning process and how we can, better fix it in regards to paying and securing funds of people.
All right, good. All right, so glad to know that, we are able to pause and just take stock of what we are doing, and the information is not just flowing from me to you and it's having no impact. So I'm glad that you're looking at your businesses, thinking about what you're doing, and getting that mindset on how you can change your business for the better. After all, it's your business, and if the business fails, then you're going to have some challenges there, and you don't want to fold up a business when the business is not really dead, and you don't want to keep it when it's dead. So good to know that you're taking stock of all of that. All right, so today we continue. All right, so for the last class, we looked at the accounting concept. We looked the double entry concept. We looked at some accounting terms. We looked at the accounting equation, journal entries, and then we ran through an example. So let us see what you remembered from what we did. We're going to do another poll, another pop quiz. So let's go. So look on the screen for the first poll question. Are you seeing it? Question 1, prepaid expense or prepayments refer to A, monies paid for goods or services not yet received from the supplier, money received for goods or services not yet provided to the customer, or none of the above. What is that? What is prepayment? Two responses so far. Three. So I'm waiting on one more. Tanisha won't be participating. So I'm waiting on one person. Okay, 4 persons. So prepayment. And the word prepay, right? It is suggesting that it's a payment from starters. So it is really monies paid for goods and services not yet received. So someone said money received for goods or services not yet provided to the customer. We're going to look at that term afterwards. So I won't say what it is right now. But for now, the prepaid expenses are those expenses or those monies that you pay for goods and services that you have not yet received. And remember that we said, as long as you pay for those goods and you have not received the goods, the money is still owing to you. And so it is a receivable, and so it will be shown with your assets on your balance sheet. Is that clear? The person who answered B? You have to answer, because I'm not sure if you understand. Or
B is
you're
the second one, right?
B is the second one.
Yes, I think that's me.
Okay, so you got the explanation for what it is then?
Correct.
Okay, all right, good. So let's go to the next poll. I don't want to share the results. I want to go to the next poll. So question number 2, accruals. Accruals are expenses because they are not yet received, liabilities which are known, are revenues. What are accruals? Accruals are expenses because they're not yet received, liabilities which are known, or revenues. So we got 4, 2 of 1. All right, I'm going to say end poll and I'm going to show you the results. Share results. Are you seeing the results on your screen?
Yes, miss.
Yes, miss.
Okay. So 2 persons said they are expenses because they are not yet received. 1 person said liabilities which are known, and 1 person said revenues. So starting with revenues, who said revenues? Tell me why you said revenues. I'm just starting from the bottom up. I'm not saying wrong or right. Why do you say accruals are revenues? You don't remember which one you chose?
Yes, I chose that one.
Right.
I don't even remember why I chose that one. I think it was something. I think you mentioned about what the accruals, but it's not coming to mind right now.
All right, so we
Something
hold
to do
on.
with income or something like that. I think you said.
Yeah, revenues are income. All right, so let's hold on and then we'll get to the explanation afterwards. Liabilities which are known. 1 person said that. Who said that? And can you explain?
That was me.
Mm-hmm.
I don't think I have a fair understanding of the word, but from what I know, it have something to do about money that you know about, whether it's money that you owe or money that is owed to you. And it can either be an asset or a liability, depending on what purpose the money serves. But the basis of it is that it's money that you know about, own or being owed.
Okay. So it means that Tishon, oh boy, and Abiathar, you both said A. So all right, Tishona, tell me why you said A.
Okay. I think accruals, it can be expense or revenue in an accounting period, but the payment, you haven't made or received the payment yet.
Okay.
So the idea that I think accrual means that it has not been paid or received yet.
Okay.
So the transaction has been incurred, they earn it. So it's like I do a training and they don't pay me for the training yet, but I know the money is out there to get. It's an accrual. Or I am to pay for something and I incur the expense, but I don't pay out the money yet. So as far as I know, it has to do with not the transaction of the actual money not happened yet. But the how do I put it? You know you are to pay it or to receive it, but the money not move yet.
So you have the concept right, but you're mixing it up with something else. So we're going to
Okay.
sort that out. So Abiathar, tell me.
All right.
All right. So accruals simplified means the expenses business would have accord per se revenues, but it is outside of the financial period. And if it say per se the financial period has closed, they would have to record it in the next financial period.
All right. So I got somehow I think that you know what it is, but maybe the answer here is what you're not necessarily sure what to do. And I'm talking about all of you. All right. Now, what are accruals? Remember yesterday when we were going through, we said that we looked at some things that were on the balance sheet, right? Does anybody remember us saying that accruals are things that you actually owe, right? I remember what we classified, things that are owing, what they are called. You remember? Assets, liabilities, or capital.
Liabilities.
Right. So if you owe it, it is a liability. Now, what are these accruals? It would have been things that are done, as Tishana was saying, things that you would have got services done for you, or you would have incurred expenses for something, whether you bought something, but you did not pay for it. You know that it exists. You didn't pay for it, but you need to record it in the period that it occurred. So if, for instance, and I think I'd use the light bill as an example. I say, if it is that you did not get your light bill from JPS, right? You know that there is a light bill incurred. You are in the building, you are using the light and so on. You did not get the light bill, but you know that there's a light bill. You incurred electricity charges. What you need to do is make a record of that expense, right? So it's a liability because you owe it. You incurred an expense, but it is a liability because it is something that you owe. So these are liabilities which are known to you, but which you have not yet paid for. Is that clear? So accruals are not expenses. Accruals are payables. They may be payables for expenses or for goods or for services, but they are actually liabilities. Is that clear? Remember, liabilities are things that you owe. Accruals are things that you owe. So you would not put it in your expense per se. You would have to show it on your balance sheet as a liability. Of course, you are going to show what you purchased or what you incurred that charge for. But at the end of the day, I asked about accruals, which is the liability. So B would be the most suitable answer. Okay,
Yes, Miss.
Tishana?
Miss, I wanted to ask because I remember in some accounting course before the lecture, I understand what you said. So it has been incurred. So you didn't get the light bill, but you know that it's not that the light was free that month.
Right, so you have to
The,
put it in.
the expense has been accrued. Is that good language?
Right, so you accrue the expense. So you are going to record the expense, but you are also going to show the liability.
Right. So it's okay. Right. Because you still have it owing. So it is a
Yes.
liability. All right.
You still
But
owe it, even though you don't get the bill. So not because you didn't get the bill, you can't say, okay, it's a free pass this month. Your accounting records have to show it.
right. So what I was gonna ask though now, A previous accounting lecturer would have told me that if the money, I know what accounts receivables are, the money that you are expecting to get, so it's a receivable. But there's an accounting teacher that told me that amounts of monies that have been earned and not yet paid is also considered accrual.
Monies earned but not yet paid.
Yeah.
Okay, remember, I'm just trying to, let me answer the question without trying to say what the lecturer was saying. Remember that I had said that you record all revenues in the period in which they incur, right? So remember, I was saying to you, did I say it to you or I have it on the slide that I think I probably have it on the slide. I don't remember if I said it to you before. But if it is that you, let us say, for instance, you sell some items, right? And the person paid you just a part of the monies for the item. You don't just record what you got. You record the entire thing. So if your services was for 150,000 and the person paid you half, you don't just record the 75,000 as revenue for that month. You have to record the entire 150,000, not because you did not get the other $75,000. You understand?
Yeah.
Right. So I'm thinking that's on that line that he was going to say that all revenues must be recorded in the period that they were incurred, whether you receive payment for it or not.
Yeah. I think our idea was that there are accruals that are assets. So what she
No,
taught me,
accruals are not assets. Accruals are liabilities.
yeah.
So we
No,
can
I
never.
understand what you're saying. I just wanted to know if that was bad teaching that I should rubbish. So she was saying like an unpaid invoice is a sale that has taken place, but the cash has not yet come to your hands.
Right. So
So
you have
what
a
she was trying to
receivable.
say is there are accruals. So she's saying that it has been accrued, just like how an expense is accrued. It's like it has been accrued. So she didn't teach accrued as having to do with liabilities only.
I am not sure why that term was used, but accruals are liabilities.
Okay.
And just
Got
remember
it.
that you record. So if you sell goods, as she said, and you did not collect the money, you still have to record the revenue.
Yeah, yeah. That part was clear. It was it was defining it as also accrued. That was the issue.
Yeah.
Yeah.
Accruals are liabilities.
Okay. Thank you, miss.
Right. Right. So that was question 2. So I go back, look up for question 3. The accounting equation is asset plus liability equal capital, asset equal liability plus capital, or asset equal liability equal capital. What's your response? I'm seeing 2 responses so far. All right. assets plus liability equal capital. Whose response is that? Nobody? Whose response is that? All right, you remember I'm just going back to this. Remember this equation? Remember this equation? Assets, what you own is equal to what you owe plus what you inject in the business, right? What the business has must come from you or borrowings. Simple. All right. You have to answer me, because I don't know if you're there.
Yes, I get it right?
I don't know which one you chose because I can't see the names, That's why I have to keep asking who. I wish I could see the names.
I think I chose the first one. I'm currently in class while in class, so sweet.
Oh, you're in class. So you're
Yeah.
just touching a button, Nicholas.
Yes, I
Okay.
actually chose the first one, yes.
Okay. All right. So assets, as I said, is really equal to liabilities plus capital. So it would have been B. And remember that the assets that you have would have come from what you put into the business or what somebody gave you or a combination of both. What you borrowed or a combination of both. So that's how we end up with the equation asset equal liability plus capital. All right.
Yeah. So even if you borrow $10 million loan and you don't make but no money on it yet, you have that $10 million in the business, so it's still an asset, right?
Right. So the $10 million you may have got it, let us say, as cash in your bank. So that bank would now be assets and the loan would be liabilities, and the asset would be equal to the liability. What you do with it, maybe you put it as capital or however
Or you buy inventory or whatever.
It could be
But
a
if you buy
combination.
inventory, the cash don't exist anymore. So the asset on the book would have been the 10,000 value of inventory.
Wonderful. So the $10,000 would be equal to the loan, pretty much. And that's how
the
you have
loan
your
will be
double
the
entry.
liability. Oh, so you record it on the loan under the liability, and the inventory would be the asset.
Wonderful. So that's how you get assets equal. Because your capital could be 0 for argument's sake. So assets would be equal to liabilities there, and capital would be 0. Or if you get the money and you just call it capital, then asset would be equal to capital and liability would be 0. But let us say you get the $1 million, right? You get part of it as a loan and part of it, you inserted it in the business yourself. So you would have assets, let's say the $1 million, using that as an example. So the asset would be $1 million, which is your cash. The liabilities, which let us say you borrowed 800,000 from the bank. So that would have been the bank loan as a liability. And the capital now would have been the 200,000 put in there. So that you would have now 1 million is equal to 800 plus 200. And you get the 1 million like that. So always remember, can't have a one-sided entry. And when you move monies from one place, it must go somewhere. When you get money, it must come from somewhere. You're spending money, you must be taking it out of the bank or cash or whatever to do something. What is that something? So that is the mindset you need to have. As long as you're going to spend the money, what am I doing it for? As long as you're going to use up your goods, what am I using it for? As long as I'm going to use up my time, what am I using it for? And you record the entry to at least 2 sides to that entry, because everything that you do have a value. If you're going to take goods out of your shop and you're going to give it away, you're moving inventory and you're creating a donation. If your goods on the shelf spoiled, you're going to reduce inventory because it's no longer there, and it is going to create an expense called stock write-off or stock spoilage or whatever you want to call it, right? So there's every transaction that you do that relates to the business has a value. All right, and should be recorded as such. All right, so let's go to the next poll. Number 4. All of the following have debit balances except asset, capital, expenses, or drawings. And I gave you a nice little mnemonic yesterday, so let us see who remembered it. All of the following have debit balances except assets, capital, expenses, or drawings. Who are for? Mm-hmm. 3. Waiting on one person. Nicholas, you answer yet?
Yes, I did give my answer.
Okay, so who hasn't answered? Matthew answer, Abiathar, Tishona?
Miss, I'm not sure.
Yes, miss, I answer capital.
All right, so you are not sure, Tishana. Okay. All right, so let us look at it. So yesterday I gave you a little mnemonic. Where am I? Let me find it and show you and see if you remember that one. Do you remember this one? Dead click. Dead, debit, expenses, assets, and
Remember that
drawings.
one, yeah. Dead
Never
click.
remember that one. Credit, liabilities, income, capital. Right? So all the
And then
expenses,
right after.
assets, and the drawings have debit balances, the liabilities, the income, and the capital have credit balances. Remember the capital belong to the owner, right? And if you look at it from that point of view, the revenue would also belong to the owner, right? But then you're going to have your expenses, which are going to take out of that revenue. So they have to be on opposite sides. The drawings goes against the capital. So if the capital is a credit, then the drawings, remember the drawings reduce the capital because the owner is taking money out of the business. So it would reduce the capital. So you can use this little mnemonic here to remind you, dead click. And everybody agreed that asset was had a debit balance. All right. The last poll before we get into the meat of the matter. Last one. Drawings add to the capital of the business. Is that true or false? Drawings add to the capital of the business. Is that true or false?
Hold on, I'm gonna see the poll.
You're not seeing the poll?
No, I'm not seeing it.
You're not seeing it, Matthew?
No, I'm not seeing it.
Not
Anybody
seeing it
else?
either, miss.
You're not seeing it either. Oh, I think, all right. I think it was set differently. This one was set up differently. And I can't do anything to change it. All right, so I'll ask a question. Drawings add to the capital of the business, true or false? That's the entire question. So tell me.
False, miss.
False. Drawing don't add to the capital of the business.
So the two of you say false. Tishana and Nicholas, what you say?
Unless it's a lucky draw.
Tishana and Nicholas? Not sure?
Not sure, not sure.
Tishana? All right, so what exactly is drawings? Remember that drawings is what the owner takes out of the business for himself, for his personal use. Now remember, capital is what the owner would have put in the business. So if the owner is taking monies out of the business, then it is going to reduce what he had put in the business. And remember that the capital would have been made up of what he would have inserted in the business plus any profit from the business. So it's pretty much pulling from his capital and his profit. All right, so it does not add to the capital, it does reduce the capital structure of the business. So the more the business, the owner takes out of the business, the more the capital structure goes down. All right. I hope that refreshed you, that you were able to remember some things from what we did yesterday.
Sorry, miss, I had to step away to the bathroom. Which one was the answer?
It's false. The capital does not, what was the question again? Sorry.
No, it's
If the drawings add to the
Drawing.
capital, it doesn't add to the capital, it actually reduces the capital.
okay.
All right, okay. All right, so let us see if we can engage in something different right now. So today we're going to look at profit and loss, we're going to look at cash flow, and we're going to try and attempt to do a tax calculation. All right, so now some of these things that I have here, we would have said them before in previous discourse. All right, we spoke about the profit and loss account. And what do we say we can find on this account, on this financial statement? If I jump to my profit and loss account, what do I expect to see over there? What are some of the things I expect to see over there?
That we're earning or we're losing. Profit.
Yeah, it would tell you that, but
Yeah,
anything
profit or loss.
specifically, any form of account that you expect to see over there? Your revenue, your income, your expenses. You will see your gross profit. You will see your net profit. You will see your cost of sales. All those things you will see on your profit and loss account. And as Matthew said, and as profit and loss, the name indicates, it tells you whether your business is making a profit or a loss. So some of the terms we will find on the profit and loss. Revenue. If you see revenue, it is the same thing as sales and it is the same thing as income. People use the terms interchangeably, but it's the same thing. It would be the monies that the business generates for whatever goods or service you supply. Then I did mention previously other income. Now, other income would be monies that you get in the business, but are not directly related to what you do, right? So if you have your driving school and that is what you do, you sell lessons, persons pay you, that is the major source of your income. If, for instance, let us say you sell one of the cars and you make a profit for the car, it is not treated as sales. It would be other income. If you have an accident, God forbids, and you get your insurance claim, that is not sales. It would be other income. If you have investment and you're getting investment income, that is not a part of your sales. It is other income. All right. So we want to be able to separate them because that is the only way we know if we are making a profit or loss on what we do. If you have one-off income coming in and you start bunching them up, then there may come a period of time when you think, oh boy, I did so good because I made a profit, and without necessarily taking into consideration that you actually had a one-off occurrence that gave you this amount of monies and you may not have it again. So you would be fooling yourself thinking that you're making a profit when it was just this one event that caused you to make a profit. All right. Then we have cost of goods sold. Some people call it cost of sales. And this is really all those expenses. So cost of sales are really expenses, but they are the expenses that relate directly to your making that revenue, generating that revenue, right? So Tishana provides a service. So she may need to travel. She may need to get some extra hands. She may need to, whatever the business entails, that you have to do all those expenses that you have to incur in order to ensure that you get that revenue for that workshop, training, exercise. That would be a cost of sale, right? People call it cost of sales. Some people call it direct cost. It is related to your generating the revenue. So like I was saying, Matthew, in your business, if you're going to do your stunt and you have to transport the bikes and you have to get your special cast and you have to get your uniform and gears and all of those things, those are costs relating to you generating that income for that show. Abiathar, you're going out and you have a funeral service. You have the contractor that needs to carry the bodies. You have the person that is going to dress the body and so on. All of those are costs relating to you earning that income for that funeral service, right? So I'm saying that so that you don't mix up the cost of sales with the regular expenses. Not that anything is wrong with it. It is still going to show you the same profit. It's just where you classify it, right? Because as I said, you want to know if your activity is profitable. And you also want to know, am I generating enough monies, enough profit from this activity to cover my other expenses? because you may have those expenses that go against your revenue, right? And you look and you say, okay, good, I am making a profit. And you may be making a profit, and that's good, a gross profit. But then you have to pay your admin staff. You have to pay your rent. You have to pay your electricity and your water. And by the time you take out all those expenses from the profit that you generated from that activity, you realize probably that gross profit cannot cover those expenses. And it could be telling you something that, guess what? You're selling your services for too little. You probably need to increase your services, the cost of your services, because you want to, at all time, I'm sure your aim is to make a profit. So you want to know that you are generating enough profit from your activities to cover your other costs. All right? So when you look and you see you make a gross profit on your thing, on your activity, ask yourself, is this enough to cover my other costs? And when you're asking yourself that question, know that you need to know what your other costs are. Because you may ask yourself that question and you still don't, you're still unsure of what your other costs are. All right, so you have quite a bit of things to think about there in how you price your goods, in identifying what your other costs are that are required for your general operation. All right.
Yes, miss.
Okay. So, as I said, the gross profit, which is what you get from the activity. And if you have any other income, you add it, you take out your expenses, and that will give you your net profit or loss. Right? Now, the net profit or loss, whatever you get at the end of the day, that amount goes against your capital, because the net profit or loss belongs to the owner, right? Or owners, if you have more than one owner, if you have shareholders. So if you made $200,000 profit, it goes on your balance sheet and it adds to your capital. So this is showing that your business is, your capital of your business is increasing. If you make a loss, it is going to go against the capital as well, and it is going to show that your capital is eroding. All right. So let us look, and just a note here that says that the expenses reduce the owner's equity, which is why they are on both different sides. Remember, debt click capital on the credit side and the expenses on your debit side. So the expenses would pretty much reduce your capital, and the revenues would increase it. All right, which is in effect what comes out to your net profit, which increases or decreases your capital. All right. Did you guys look at what we did yesterday? I know you're all busy people, but did you get a chance to look at some of the transactions we did yesterday when we were identifying what were assets and liabilities and so on? I'm going to assume you did.
I didn't get to look at it, miss.
Oh, okay, okay, one response. All right, so let us see if we can work this through. So yesterday we started with John Brown, right? And we had some transactions that we were looking at to say John Brown started his business, and we worked that through from doing our journal entries straight through to our financial statements. So at the end of it, we had a balance sheet which we looked at. All right. So what I want us to do now, we're going to extend that a bit, that balance sheet that we had, because all we did was a balance sheet. And we're going to look at some transactions that's going to affect this profit and loss account. And we want to see how it's going to affect it and how we're going to record it. So let us just talk through the transactions a bit first before we record them. So John Brown placed an additional $1 million in the business bank account. 50% was personal and 50% was capital. Tishana, can you tell me how, what are the accounts that are affected here?
So, say the question again?
So, you see the screen?
Yes, I'm seeing John
Okay.
Brown placed an additional amount of $1 million in the business
In the
bank
business
account.
bank account, right. 50% of it was a personal loan and 50% was capital. So I'm asking you, what are the accounts affected here? Just talk me through it.
Oh Lord, miss.
Just talk, man. Just look here. What I want you to do, take John Brown out of the question. Tishana invested $1 million in our business account. 50% loan and 50% capital. Stop thinking of it as John Brown. Think about it as you. By the grace of God, you just got $1 million.
Amen.
You're putting 50,000 in the business, 500,000 in the business, and you get $50,000 capital.
Okay. So the personal loan is a liability. But I'm not gonna have the cash as an asset. Right?
Where are you going to record that cash as an asset? Where?
In the balance sheet.
In which account?
In the balance sheet, in the...
It's right.
Huh?
It's right there. It says it. In the bank account. So the bank is an asset, right? So you're not going to go to the balance sheet and just type it in assets. You're going to put it in bank underneath assets. So bank is an asset, right?
So I'm going to put the 500,000 as an asset. Okay. But what do I record it on over the liability side?
Anybody else want to help Tishana work this through?
Please help me, someone.
Talk it through. You get $1 million.
And the 50%, the 500,000 capital is recorded on the assets too. And there's another designation on the capital.
Dead click.
What's that term you just said?
Think of dead click.
Okay.
So the capital is going to be on the credit side. So capital is an account by itself. Remember the accounting equation, assets equal liabilities plus capital. Right. So just like how you have assets, you have capital and you have liability. You said that the bank is an asset. You said that the loan is a liability. So the capital is capital. So the $1 million is divided into, let's call it 3 parts. The 1 million went to the bank. 50% of it, which is 500,000, is a loan, and 50%, the other $500,000 is capital. So you look at it in your mind's eye. You see the assets equal liability plus capital. 1 million equal 500,000 plus 500,000.
Right.
Got it?
I would debit on the bank 500,000.
Yes. No. 1 million. 1 million, all of it. Yes, man. All of it went to the bank, you know. But
right.
But
all would I credit the loan?
Yes, because it's a liability. So now you have 1 million equal 500,000. So you need the other 500,000, which is going to be capital. So the entry would be
so the
debit
owner's
the
capital
bank.
is credited.
So you debit the bank with $1 million because that's what's going in your bank. Then you
In
would
total.
credit your liability, which is the loan to you, for 500,000, and you would credit capital with the other 500,000, and so you would be balanced.
Right.
All right.
Yeah.
Good.
That's
Good,
the
good
toughest
job.
part for me. The good
Eh?
thing is, well, the importance is to understand that, because like when you're dealing with QuickBooks, it will do this in the back end once you put in the right thing.
Right. So what you need to remember is that you're putting the right thing, because it's what you put in you're going to get out. So even this that I'm saying, it is important that you understand this, or else you won't put the money in the right place.
Right.
So he buys oranges, 20,300 oranges at $50 each, and he paid cash for it. What's happening here? So I want you to think about it in your term. You don't have to think about it as John Brown. Don't go that deep, right? You are business people. Don't even think oranges. Just think about what you do, what you buy, and tell me what would be affected.
Can I answer, Miss?
Go right ahead.
The accounts I think are affected would be cash. The cash would be asset as the business bank account increases, and then sales, the sales revenue, it would be part of equity, which would include capital, and the revenues earned from this would be earned from the sale of the oranges in Dick's example per se.
Which one
And
are you doing though? Hold
asset,
on, Abiata. Which one are you doing?
he purchased.
Okay, he purchased. Okay. I thought you were doing the one below.
Oh, sorry, I was doing he sold 20,000
That's why
oranges.
it
So sorry
sounded
about
like
that.
it sounded like that's what you were doing. That's why I was wondering. Okay, so you're supposed to do he purchased.
Right. So sorry about that. He purchased. Just a moment. Alrighty,
All
so
right.
the accounts affected would be inventory, which would be asset as the business acquire, the business would procure the oranges, and cash, I think because the business bank account will decrease.
That's correct.
Asset again, okay.
That's correct. So inventory would increase because he's in the business of buying and selling oranges. So that's an inventory, not an asset, not fixed asset. So he's buying oranges to sell, inventory, and then the cash is decreasing because he's taking the monies from cash. And the value would be the $30 times the 20,300. Matthew, he sold the oranges now at $50 each, cash.
All right, he sold oranges at $50 each. So that would be what, a debit to his inventory.
All right, don't think debit and credit yet. Just tell me what is happening in the transaction. He sold the oranges. So what is happening there?
He's selling the oranges, what, for an upmark of $20.
So what accounts you see affecting here? I don't want you to tell me assets or liabilities yet. I just want you to tell me just plain what you see there. The oranges that he had going down, right? Because he had bought 20,000, he had bought 20,300. Now he's selling 20,000. So the orange is going down, right?
Right, correct.
And he's now selling for $50, and he had paid $20, he had paid $30 for them. So as you said, he's making a profit just on the cost of it, but for of $20, right? That's all
Correct.
that's happening there.
Right.
And yes, as you said, the inventory, which is the orange inventory, would be going down. So it's going to be a credit to the asset. Sorry, to the asset, which is the inventory, right? And it is coming out of cash. So cash would be going down. All right.
That should be going down.
Thank you, Matthew.
Yeah,
What's
come
happening?
listening just to show you.
Cash should be going up. Thank you, thank you.
Right.
Should be going
Right.
because
Right. He's crediting that note to his bank account.
selling for cash. So the oranges are going down and the cash is going up. Correct, correct, correct. All right. The next one, transportation cost is $2 a cost that's related to dealing with the oranges. And it's $2 per orange. So what we would have to do, how many oranges did he purchase? 2 oranges, 20,300, $2 per orange. So it's $2 times the $20,300, and that will give us a transportation cost that we need to record. Right? And that is a cost of selling the oranges. Then we went on and we see he had wages for the mango pickers and so on. So what I want you to look at this now and tell me, where would we put these transactions? When I tell you them, you tell me where. Is it going to be an expense, other expense, or is it going to be a cost of sale? Wages for the mango pickers.
That is an expense.
Anybody else? Where would I put wages for the mango pickers? It's your business. Where would you put it?
Are we just doing expense and cost of sale? Miss Karen is still there.
Digicel kicks me off. Sorry about that. Are we still there?
Yeah, man, still here.
Matthew? Okay. All right. I got kicked off. Sorry.
That's all right, miss. Yes.
All right. So tell me now, wages for mango pickers, where would you put it in your accounts?
Expense, miss. I chose expense too.
Tishana, what you say? Where would you put it? You would put it as a part of your cost of sales, or you put it as a regular expense?
What? Sorry, the $2?
The mango pickers.
Cost of sale.
All right. Where would you put plastic bags for packing the mangoes?
Same
Cost
thing.
of sales.
Okay. Where would you put the admin
Maybe
salaries?
one second, but the plastic bag is more direct, so now I'm questioning the first response I gave.
What's that, Tishana?
Yeah, because them have to pick the mango in order for you able to provide it to the customers.
Which
Right.
is
So the
Right.
plastic
to you.
And that's what I argued at first too, Tishana. I was saying that it's a bit tricky because it could be argued that it could fall under cost of sales, but then it would be safer to classify it as an expense.
Okay. So the plastic bags I'm talking about, you're selling the mangoes, you're going to package them in the plastic bags to sell. Does that make your argument different? Abiathar? That makes your argument different?
Miss, I wasn't talking about the plastic bag question, miss. I was talking about the first one, miss.
Which one there? The wages?
Yes, miss, for the mango pickers. So sorry about that.
Okay, and what were you saying about it?
Tishana was saying, miss, that she chose that it could be a cost of sales. And I was saying that I chose that it's an expense, but I was arguing that we could argue that it could fall in both categories, but it would be safer to classify it as an expense.
Oh, so you're saying the mango because it's expense.
Right, miss. That's what I chose, miss.
Okay. And the plastic bags you're saying is what?
The plastic bag would be cost of sales, miss.
Okay. All right. Where would we put the admin salaries?
Expense, miss?
Statutory payments. Do you know that the statutory payments is actually an expense to you? As long as you have staff, you incur a statutory payment. Whatever you pay your employees, then you need to match that and pay it over to the revenue, pay it over to TAJ. So as long as you have employees, you are going to have a statutory payment as an expense. Right?
Yes, miss.
So the statutory payments would be admin. If you have cleaning expenses, admin, water admin. Let's go back to you and the wages now. Let's think about the mango, the picking of the mangoes now. Remember that he's in the business of buying and selling the mangoes, right? So that is directly related to the operations. That is a part of what is needed in order for him to sell the mangoes. So it has to be a part of the cost. You got that? And the transportation cost to transport the mangoes from wherever, whether it is to from the farm, Clarendon Farms, I think that's what we were saying, to Mr. Brown, that would also fall on the cost of sales, because it is a cost that is directly related to getting those mangoes to a saleable position. All right, and that's why they're considered cost of sales. The admin type related expenses, the ones we're calling expenses, you can't really tie them to the activity. It's just a general thing. You can't say you're paying admin salaries for $50,000. It is for the 20,000 mangoes. You have different activities going on, right? And so we group those things as people call it, some persons call it just expenses, some call it admin expenses, some call it other expenses, but it is just expenses which are not directly attributable to the item that you're selling. Go right ahead.
Right, miss. Question, miss. Let me know if I'm thinking it too deep, right? So since orange, right, is the primary product, and the wages are for mango pickers, wouldn't it be safer to classify it as
Oh
an
my
expense?
gosh. Oh. Now I see what you're saying. Excuse the term. It is supposed to be orange. I don't know why I'm talking about orange and writing mango. Oh Lord. It is supposed to be orange, not mango. That's the term that was confusing you? Because I
Yes,
had
yes, miss.
mango.
Because if you had, say for say you
Oh
had
my.
fruit pickers, right, then we could choose any fruit. It could be any fruit across the board. But then you said, so I was a bit confused there. Thank you, though.
Thank you for pointing that out to me. Because I was just thinking that I had the correct. It was supposed to be orange pickers. That's what what are we selling? Orange or mango? I don't even know what we're selling. Oranges or mangoes? No, I don't know what we're selling. Okay. So
I think we selling oranges, miss, because we
It's
just bought
orange.
20,000.
Oh boy, I don't know what we're selling. Okay, orange. Okay. All right. So these are the additional transactions that we have for Mr. Brown. As I said before, in the last class, we had done some transactions for him and we came up with a balance sheet. So now we want to see how these other transactions affect the profit and loss account, how it affects his balance sheet. We're gonna see how it goes over into a cash flow statement. All right. And if we have the time, then we will see how to calculate the tax on what he made. Right? All right. So let's move on. Keeping the accounting equation in mind, which is assets equal liabilities plus equity or capital. If there's an increase in your assets, it's a debit. If it's a decrease, there's a credit. For liabilities, increase is a credit, decrease is a debit, and it's similar for equity or capital. All right, so let's keep that in mind and let us look at the transactions. Now then, all of these transactions that I have here, these are, who can tell me what this is? What record do I have here? Huh?
Financial statement, miss.
These are the journal entries. Because what we had a while ago were some notes that tell us what Mr. Brown did, right?
Right, miss, that's true.
So these tell us what Mr. Brown did, but they're not going to appear in the accounts magically. We have to do something with them. So whether you're using a manual system or you're using an electronic system, you have to do the journal entries. And it is just creating a transaction in the system. So we're showing it to you in manually. When we get to QuickBooks, we can input it in the system, because all we would need to do is input the journal and we get straight to the financial statement, right? So the first transaction was when we made the deposits, when he made the contribution to his account, the $1 million, which Tishana was speaking of. So the bank got the $1 million and we created a liability, which is a loan to Mr. Brown, and the capital. And remember, usually when you put capital in the business, it's sunk. You're not taking it back out. You just put it in there. But in this case, Mr. Brown said, listen, I am putting up $1 million. I need back 500,000 and the rest can go towards capital. So that's the first transaction that he made. Then the next thing, there was a statement in there that says that Mr. Brown needs to be repaid. I mean, it's a loan. So we record the repayment of the loan to Mr. Brown, where we take it back out of the bank and we give it back to him. So his liability would now be gone. We don't owe him anymore, right? See, we had owed him here and we now paid him, so we don't owe him anymore. The bank went down and his loan went off the books. And see, I'm getting my fruits mixed up. I'm calling them oranges and I'm calling them mangoes. So please ignore my error there. We're dealing with a fruit, same fruit. So he bought some fruits from Clarendon Farms, 20,300, and he bought them for $30 each. We discussed it. The inventory for the fruit would go up 609,000. And the bank would go down by 609,000, which is the 20,300 times the $30, what we actually paid for the fruit, right? Then he sold some fruit. He sold 20,000 mango fruit at $50. That's $1 million, and he put it to the bank account. So you see, the bank account went up, which is an asset, and now we have revenue. This is the sales, right? The 20,000 mangoes at $50,000 give us $1 million, and that is our revenue, right? But there is a cost to it. The cost of those mangoes that we sold, it cost $30 each. So we have to record the cost of the fruit that was sold. So anything that you are selling, you need to record the cost. You need to set off the cost of the item against what you're selling it for, even if you have inventory left over. All right, let me try and explain that. So in the case of, let us say mangoes, you bought the mangoes and you sold them for $50, but you bought them for $30. You did not sell all the mangoes. You only sold some of them, right? So it means that some would be left in inventory. And what would be in inventory is what you bought them for, nothing else. So when you're selling it, you're going to take them out of inventory at the same thing you bought them for. So at this point, you would have now taken 20,000 at $30, right? That's how you're going to get your profit, because you sell 20,000 for 50, but the 20,000 costs you 30, right? And that's how you get your profit. And what is left over, the 300 that's left over, would have been inventory. It would have still remained in inventory at the $30, what you purchased them for initially. All right. So when you're doing your accounts, don't just be taking out the things out of, say you sell it, and then there is nothing to show what you purchased it for. Or you're taking out and you completely forget that you still have stuff left over in inventory, or you're valuing your inventory wrong, because the inventory must be based on what you purchased the thing for. All right, and see, we go down here and we're recording the transportation cost. It is a cost. Cost of sales, $2 per mango of what you sold. So it's the $40,000. Then you have the labor for the pickers, $30,000, the plastic bags, the salaries, and so on. And if you notice, I separated what was cost of sales from what was expenses, right? And so you need to ensure that you are recording all your costs that you incur. But this is Mr. Brown's business. All right. So what I did was that I took the original balance sheet that we had that we worked on yesterday, and I made the adjustments, right? Here, I want to see if I can show you. Let me show you another sheet. All right, I'm just showing you the workings for now. So right in front of you, I have an extract from the balance sheet, and I have the income statement. I just wanted to show you what was happening in each case, right? So here, revenue, this is a $20,000. I don't know if you can see in the cell that I have, the 20,000 fruit that we sold at the $50. I want to show you where we bought it first. So let's go to inventory, right? So here in the cell, you see I have where I bought the inventory, the $20,300 times 30. I remember I said, just pay attention to this part first, right? So that's the 20,000 that we bought at $30, right? And you see I record it in inventory. If you go in the bank, so I'm just showing you the transactions that I did. If you go in the bank, you will see I recorded the same 609,000, right? I'm just showing you the double entry. So you see it in inventory and you're seeing it in the bank, coming from the bank. Likewise, when you sold it, see, it is coming out of the inventory here, right? And it is coming here as your cost of sales. So you see the double entry taking place here. So I did the debit and credits. What is happening on the income statement? You're selling the fruit. This is the cost of the fruit. This is the transportation cost. This is the wages. This is the plastic bag, and so on, right? And see, at the end of the day, if you look on my balance sheet, you will notice that I'm balanced, right? Oh, what did I do? What did I do? What did I do? Okay, I did something a while ago that threw my thing off. What did I do? Okay, it's back. Right. So you will see that my balance sheet is balanced all the way, which means that each time I did a transaction, I had the corresponding transaction. If not, I would not have balanced, right? So you see the total assets here, and you see the net profit, the capital here as the same. This was the original bank statement that balance sheet we started with. These are the transactions I did, debit and credit going on, and this is my closing balance sheet. And if you look over here, the same transactions that we just walked through a while ago, see, I now have them in a form that is representing the operating statement. Not the operating statement, sorry, the income statement. So we see the fruits that were sold. We see the the cost of the fruits that were sold, the 20 at the $30. That relates to the fruits that were sold. Transportation cost, the 20,300 at the 2, the 30,000, the 15, and so on. At the end of the day, we see that the gross profit is 340. And he also had other expenses, salaries, statutories, cleaning, water, and so on. And at the end of the day, he made $244,100. Now, if this was your business and you look at this business, what kind of information do you have here? Anybody can tell me what you would look at this income statement and think of what would be your challenges? What would you want to work out? What would you want to test in this case? It's your business and you have a result like this. Would you be happy? Would you want to work out any form of analysis on this to see if the business is going the way you want it to go?
Yes, miss. Right now I would try to get new suppliers for my fruits, miss. 'Cause right now the fruit expensive, pardon.
Why do you say that and you're making a gross profit? I'm just asking.
I am making a gross profit, but is it really enough when you look at all that I'm paying to acquire the fruits, the transportation costs and all of that, and maybe say per se I do not own the space that I store my inventory, right? That would become a factor as well.
Mm-hmm. All right, so you're making like your gross profit there to sales is 31%. So you know, as a business person, you need to say to yourself, okay, what kind of gross profit margin am I looking for? Right? Suppose you say, I want my gross profit margin to be 50%. 31 is too small. Right? So in looking at this, you have choices. So the choices could be to increase what you sell the price of the fruit for, or as you say, you could get cheaper fruit. But you need, as a business person, to have in the back of your mind what profit margins you're working with. What can you live with? Right? If you look at what else would you be looking at? I think Nicholas seemed to be gone. So Tishana and Matthew, what else would you be looking at? You put in all of your information, you inject capital in the business, and you look at it, you're only making $244,000. What information you think you can glean from this that will help you to make any other decision?
I mean, if it's a start, it's not bad. You look for see where you can cut some costs.
Would you look to see or try to find out, okay, what other other persons in the business getting on their on a similar business? Because suppose that is really how where the margins are supposed to be.
Yeah, well, there's definitely room to assess competition and things like that.
And you also have to forward plan, because if it is that you decide the admin salaries, for instance, is just $50,000, and you might say, okay, but I'm going to need an operations manager because I am spending too much time on this when I could be doing other things. You know, you're going to have to pay the admin, pay an operations manager. So you're going to think, okay, will the $314,000, that's the gross profit, would that cut it? Would I be able to pay an operations manager? If I do get an operations manager, what price or what cost can I get that person at? Right? You may say, I mean, I know that the plastic bag costs are small, right? But you may say, okay, let's not use that type of plastic bag, but let us get another plastic bag, or let the people come with their own container to get the mangoes, right? So it is good. You may look at it to say, well, transportation cost is 40,000. Maybe it would work better if I get my vehicle, it will work out itself better. So I'm saying all of this to say that, which is the crux of the matter, your accounting information is important because it helps you to make decisions. Right?
Where you can see the numbers and where
You see the numbers. If you look to your left on the balance sheet, you will see that you have $775,000 in the bank. You're not really, you have little money. So you can probably buy a vehicle. The pickup that you had there, is it time to get rid of the pickup?
Right. So just like Abby say, you must see the cost of the mangoes here on the statement and know that, you know, some I did say in my mind somewhere else where we can get a little bit more affordable. You know, you can compare analysis with your figures and what you have in your brain already, you know, experience and so forth.
Yeah, man, you look on the information, because if you look on your balance sheet, look on your balance sheet and tell me one decision you think you could make there. I'm looking at there, I just look at it and saw something. I wasn't thinking about it. But look at your balance sheet, what you have there. And tell me something when you look on that, what you think you could do. It's not anything major, just something you could do.
Catch water.
Tell me.
Catch water.
Catch water?
I'm
What's
just
that?
kidding. I'm just kidding. I'm just
No, I
checking.
was trying to follow.
Just see the water upon the statement there. Just see where we can adjust.
Oh.
But I'm interested to hear what you see, Miss Karen, in all honesty.
No, so I'm looking at it and I'm like, oh, we have $775,000 in the bank, but we owe Clarendon Farms and we owe Wife Brown. We can pay them, right? We don't have to owe them. That's all.
Okay.
That's all I just looked and saw it. That's why I said. How do you spend your money? You know, you can buy more fruits too, but then your fruit may be perishable. You don't want to buy so much fruit and they spoil on you. So that's why contracts are also important. So you have like a just-in-time inventory. When your inventory reach a particular level, then you should have your suppliers ready to come and deliver to you. You should wait until they run out of stock.
The fact that on one side of the statement we have loans and owings, liabilities over here.
Yeah.
No, yeah, it was just more focused on the middle section and not really looking at the far left.
Oh, this is the balance sheet.
Right.
Let's remember, we were looking at the additional transactions. We did this part yesterday. And then these were the transactions for today. And this is what we end up with after we do today's transactions. So this is our story right now. right? So if you look at it, you'll see that we're not doing bad in terms of our capital structure
Yes,
either.
we're doing good, Abby, man. We're doing good, man.
Yeah, man, you make a profit and you have $900,000 in capital. So your capital,
Yeah, bro.
if it is you want to say, okay, what is my current assets to current ratio? I mean, you don't owe nobody. It's just $17,000 versus 806,100. It means that you can cover your 806. Sorry, I'm just working out a ratio, which is so, I mean, it's nonsensical, really, because you can cover this liability so many times. This mouse not working, Lord. Oh, directory. You can cover this loan 47 times. That's what this is saying. So you're in good standing there, right? What else can you see from here? You talk about your net worth, your assets over your liability. Your total assets is 1.1 4 here. What is your liability? So your net worth, you are in a good net worth position. So when you see your liability start to get out of hand and you see you don't even have assets there to carry you, you know that you have a problem. All right. So when you hear people talking about the net worth, you look at your assets versus your liabilities to see if anything should happen, could your assets cover your liabilities? Could you sell your assets and pay off your debts? If you can't sell your assets and pay off your debt, you have a problem. If your debt is more than what you actually have, what you own, you're having a problem. All right? Okay. So that was our balance sheet. Any questions on that?
Yes, miss. Will you teach us how to work Microsoft Excel with this, miss? The specific concept, how to add the percentage sign and how to do what we were doing on the side to try to pay the loan 42 times over.
Or you want Excel course?
Just a short mini, should say, as we do have a background, we understand Excel per se, but just to put in this new information now. Yeah.
All right. Anybody else want that, or we can do that when we're doing one-on-one? Tanisha, you good? Give me a thumbs up. All right. That's it, Tanisha. Hope she's hearing.
Yes, I'm hearing this. It's just I couldn't get it on the screen. Sorry about that.
You're good?
Yes, ma'am. Yes, ma'am.
Okay. All right. So, yeah. I know Tishana know how to use spreadsheets, right, Tishana?
Miss?
You can use Excel, right, Tishana?
Yes, I can.
Okay, you're gone very low. And Matthew can.
Yeah.
So when we're doing coaching, then you show me exactly what you want me to show you here.
Okay, no problem.
Okay, thank you.
Yeah, man, I can just show you some shortcuts or to do some things then. All right. So then, so we saw where we had those transactions. We amended the information that we had at the previous class, and we come up with a new balance sheet, and we also ended up with an income statement. Now, From that same information, we can generate a cash flow statement. And what the cash flow statement does is that it just shows us the cash flow in and out of the business from whether internal or external sources, right? And you use it to determine the liquidity position of the business. Do you have cash? So, as I said, the cash may come from the operations of the business, or it may come from financing activities, and the financing activities may be the things like getting a loan, the owner putting in capital, that kind of a thing. That's financing activity. And you may spend it on things such as buying fixed assets or investing in other companies or in other other items. All right. So that's pretty much what the cash flow shows. The cash from the operations of the business, how you use that cash. Cash from financing activities and investing activities. All right. All right, so there are some basic rules. And I just want you to think of it practically when we are preparing the cash flow statement. So the cash flow statement really shows the movement of cash. So if we have any non-cash activities in our accounts, we take them out, right? Now, when I talk of non-cash activities, we talk about things like depreciation or any interest earned. So if we don't get the cash and we just record it, then we have to take it out in order to generate our cash flow statements. Now, I mentioned depreciation. Any asset that you have, except for land, is a depreciable asset. What do I mean by that? As a business owner, you have your assets. They are not going to stay the same all the time. So what we have established as accountants and as business owners, you can set your the lifespan of your asset then, or the depreciation rate, right? Typically, for instance, a motor vehicle, the depreciation rate is over 5 years. So it's at a rate of 20%. So each year you have to depreciate the vehicle by 20%. Of course, in your accounts, you do it on a month-by-month basis. All right. So every month you are supposed to show the depreciation for your vehicle, and it's an expense. All right. So that needs to be shown in your accounts. So all your assets there, you classify them under different categories, you group them, and then you apply the depreciation rate to them. So as I said, motor vehicles is typically 5 years. Plant and machinery tend to go longer, about 10 years. Buildings, persons use buildings for, I think like 33 years, sorry. You have computers, persons go like 3 years. What else is there? It's based on the nature of your business. So if you have a business and you realize that, okay, my vehicles mash up in 3 years rather than 5, then you amend your depreciation rate. That will be a company policy. So you need to set your depreciation policy for your company. It could be the standard one, or it could be what you know to be true to your business. All right. So remember, your accounts need to show your depreciation rates. All right. Then on the cash flow statements, if we have an increase in asset, and I just wanted to think about it. If we have an increase in our assets, the cash flow shows an outflow of resources. What does that mean? If you buy assets, it means that monies must go out. And remember, it's the money you're trying to reconcile, right? So increase assets outflow. So you have to show it as a credit. If you have a decrease in assets, it means you have an inflow. That means you're not spending your money. If you have an increase in liabilities, it's an inflow, which means you're not paying your debtors. If you have a decrease, it's an outflow, which means you're moving your money out and your liabilities are going down. And at the end of the day, it shows your available cash or cash resources. So at the end of the day, whatever you end up with on your cash flow statement, that is the same figure that you're going to find on your balance sheet. The same bank figure or cash figure that's on your balance sheet, that's what your cash flow statement is going to end up with. Which means that if when you finish doing your cash flow statement and the figure is any different from what is on your bank statement, from what's on your balance sheet rather, it means that something is wrong. All right. The financial statements, the whole double entry concept work right through your financial statements, right? And they will show up if you have a problem. They will show you that you have a problem. I know this is a lot of stuff, but if you get the time, you can just look back at it and challenge yourself to try and understand. Use the notes that are being given and challenge yourself. If you have a question, then you can ask. All right, so this is the cash flow. I'm gonna show you back on the worksheet. I'm just gonna hide. As I said, the statements are interrelated. I hope you can see the sheet, because I didn't want to separate them because I want you to see how interrelated they are, interconnected they are. All right. Oh, one thing I didn't show you when we were doing the profit and loss account. I don't know why each time I come on this thing, it changes. Come on. What am I touching? I'm touching something and I'm not sure what I'm touching, and each time I touch it, it changes and I don't know what I'm touching. Oh boy. All right, what I wanted to show you was that this net profit here ended up as the net profit over here, but I can't demonstrate that because the thing just changed and I don't know why it changed. All right. You'll see it on the slide though. Let me show you. I'm just going back a bit just to show you something.
So that money would become capital now, me? Sorry?
Yeah, it's a part of your capital structure. Look here. See, the 900,000 here was what you actually invested in the business. You had 400,000 when we started, and then you remember the transaction we did with the 1 million where part was loan and part was capital. So that's how you end up with 900,000 that the owner injected in the business. But if you notice, the net profit belongs to the cost to the owner. So the net profit forms a part of the capital base. So whatever it is that you end up with as net profit, it comes over on your balance sheet as a part of. So you notice the capital before we look at here, we only had 400. We never had any net profit yet because we never started nothing yet, right? So we only had 400. But now we are at 1.144 million because we have now added 244,000 of net profit. So as long as the business is making a profit, it will always look good, right? It will always show that the business is healthy. If you're making a loss, it means that this 900, if this was a loss, it means that you would have moved from 900 to 600 and odd thousand here, so. Right? So it would show that your capital is eroding. But what is happening here is that your capital is actually increasing. And see, this is the 244, the net profit that we made that went over into the balance sheet here, into the balance sheet there. All right. Now it is this net profit that we're going to use to start our cash flow. So here's how it works. Okay, I wanted to show you the spreadsheet. So when we're doing the cash flow statements, what we start with is the cash from the operations, the cash flow from the operations, which is the profit here, right? So this net profit that we end up with is what we start the cash flow with all the time, right? We start out with this net profit. Then we look at the movements on the balance sheet. What did we buy? What did we use our monies for? Because this 244 is coming from the operations, right? Right? The 244 is coming from the operations.
Yes, miss.
So we look at now, what else did we use the monies for? So here we look at the inventory. So we look at all the items in the balance sheet, So I'm just gonna hide the income statement for a while because we're not using anything there. So, right. So here we go. So what did we use our money for? There was an increase in inventory because we started, we have 31,000, right? It means that we would have used the money in the amount of 31,000, so it would have reduced our cash resources, right? So that's why I have a credit, because it's an outflow. So outflow is a credit. So it is reducing this, right? Then we never had any receivables. So we want to make sure we account for everything on the balance sheet. We never have any receivables. Then payables, which is these two, right? We didn't make any payment on it, so it's an inflow. If we had paid them, it would have been an outflow and it would have been a minus, right? But we didn't pay them, so it's still an inflow. It's considered an inflow. When we went down here, so this would be the cash from operating activities, because we had to buy inventory, we had to get loan or whatever it is for the operations of the business. Now, how else did we get cash in the business? When we come down here, we see that we had capital of 900,000, which is this, right? And that's an inflow. We got money in the business, so that is increasing the cash resources. But we purchased plant and equipment. So up here, you see that we bought equipment. So that's an outflow. We spent money, right? So we had financing activity of 900,000, which was the capital that we put in, and we had an outflow from investing activity, which was us buying the vehicles, right? And that's an outflow. And at the end of the day, we end up with 775, 100. That's all the activity that's taking place. And if you look on the bank statement, on the bank account, you will see it's a 75. So it's showing that this was how we use our cash resources during the time we're working with. You will see, you can look at this to say, somebody will say, okay, where did I get money from? And you can say, okay, I got 244 out of the operations, along with the assets and liabilities. So it's a total of 310, a net total of 230 rather, that you got from the operations. And you can say, okay, from the investing activities, capital, I got 900,000. And this is just you reading the cash flow statement. This is not you jumping back to the balance sheet or jumping back anywhere. This is you reading just the cash flow statement to see how you use their cash during the period, how you get cash, how you use it, right? So you got capital, you didn't pay any dividends, you didn't get any dividends, but you got capital, which is an inflow. And remember, the minus sign means it's going out. Without the minus, it means it's coming in. So you got capital in of 900,000, and you bought assets for 355,000. And that is how you end up with cash of 775,000. All right. So again, all of these things, I worked it using a spreadsheet. When you throw it in your accounting software, it is going to give you this. But the critical thing is that you know what you're putting in. Because, what's it saying? Garbage in, garbage out. If you put in wrong information, you're going to get wrong information out. All right? Is that clear?
Yes, miss.
Tishana, you good? All right. So now, since we got to the cash flow statement, so we looked at the balance sheet, we had the amended balance sheet based on the transactions that we had during the operations of John Brown. We were able to generate a simple profit and loss account. We saw where the profit from the profit and loss account moved over into our balance sheet and increased our capital base. And then we were able to generate a cash flow statement from that, which balanced back to our cash. And what we were really looking at is how we used our cash, how we managed our cash, how we got our cash, how we spent our cash. All right. And at the end of the day, we came back to what is in our bank account, and we can say, yay, we are balanced. Now then, we want to see, now that Mr. Brown has made a profit, what are his obligations to the tax authorities? So just some notes. All persons who receive an income or gain or profits, and all organizations are required to pay income tax. All income is taxable, except those that are specified by the tax admin. So some things like persons getting a pension and so on, they may not have to pay tax on that. All right, and then there may be special applications with persons receiving dividends and so on. All right. Now, in terms of personal income tax, the rate is 25% for income that is less than 6 million per annum, 6 million per year. And this is after you apply the tax threshold. In 2024, there was an increase in tax threshold to 1.7 million. It's really 1.700088. It's not straight 1.7, but we call it 1.7, right? So the income tax threshold increased to 1.7. Now, prior to that, it was 1.500096, right? So what it means, because we do not have a straight financial year running from January to December, when our tax year is from April to March, right? So what it means is that there is an overlap of the thresholds. So for the financial year 2024, the tax threshold actually work out to be about 1.650, because you have to use the portion for 2023, 2022, 23, and 2023, 24, right? Because there were two different rates. So we had to apply them out like that and do an average, and it is 1.650, I think it was, right? So in calculating your tax return for 2024, you wouldn't use 1.7 and you wouldn't use 1.5 because of the mix. So any income in excess of $6 million is subject to a tax of 30%. All right.
Really, miss? Locally in Jamaica?
Yeah. You didn't know that? Yes, man, we have, as long as you go over $6 million, 30%.
Why though?
No, discouraging you from earning. I don't know. Trying to get the persons in the higher tax bracket, in the higher income
Okay, so
bracket.
I'll just tell my client 5,999,000. Thanks for letting me know.
Yeah. Right. So as long as you over 6 million. Yeah. And it's the excess, the excess that's over 6 million, that's at the 30%. So you would have
income in excess of
Eh,
which in excess of mean over.
excess. Yes. So as long as you're below that, you'll be at the 25%. When you go over, you go into
Hold
the
on. So what if I
30%
do
bracket.
two $4 million contract? Does it mean on one transaction or for the year?
For the year.
Okay.
For the year. And remember that you are taxed on not on your income, so it would be after you take out your expenses and so on. So if you have a contract that is $8 million, and then after you apply out your expenses and you're below $6 million, then you're paying the 25%. It's not on what you earn. It's at your net position at the end of the year.
Yeah, it would be nice to see the breakdown in terms of what goes into that 30% tax. Like if it was on salary, you could say education tax, income tax, like what percentage go to each tax. It would be nice to see what percentage goes to what from that 30%.
What percent goes to what?
We're gonna have a TAJ person coming to us still, right?
I don't know that they tell you what the percentage go to. I don't know if you mean in terms of working out your tax. That's what you're talking?
Right. I was saying just like when we're dealing with, say, a salary, a pay slip, you would know that a percentage goes to income tax, whatever it goes to
We're gonna
NIS.
look at that.
Can we get a copy
Like this?
of that spreadsheet, Miss? Excel sheet, if you don't mind?
The Excel?
Yes,
Oh,
please. I would want to apply to my personal business and use that as a guide as well.
Okay.
Okay, yeah, see it here now.
This is what you're talking?
NIS, education, NHT. Right, because it's those same categories we're paying in as a
Right.
yeah.
So what your statutory obligations are. So this is what we were coming to, because we were looking at John Brown. So John Brown at the end of the year, he earned $244,100. Now remember, I spoke about the threshold. So here you will see that his profit is 244. He's entitled to a threshold, right? Of 1.65. That's what it would have averaged out to be in 2014 because of the mix of the two different thresholds that we had, the 1.5 and the 1.7, because we are now in the 1.7 brackets, right? But at the end of the day, because he earned just 244, he didn't have a taxable income, so he would not pay income tax, because income tax is calculated on a taxable income. And the taxable income is the profits or earnings that you have for the year. You take out the threshold, you take out the NIS, and it is on that you would calculate the 25%. So you are allowed a threshold before you calculate your PAYE, right? So Mr. Brown was way below the threshold, so he wouldn't have to pay any PAYE. But he still has other obligations. So as a self-employed person, he's required to pay NIS. Now, NIS has a maximum, it has a ceiling. So the most you can pay on NIS is 6% of $5 million, which works out to be 300,000 for the year. So if you earn more than $5 million, you will only pay 300,000. If you earn less than 5 million is 6 million of what that figure is for the year, right? So in this case, all Mr. Brown will have to pay is NIS of 6% on the 244, because that's all he had, right? Again, the maximum you can pay for NIS is 300,000. There is a ceiling, right? Unlike the other tax types. So education tax now. Education tax is at, you're going to take your income, you're going to take out the NIS and pension if you have a pension to an approved pension scheme. And it's a difference that you pay, you calculate the NIS payable on. So you start with your income, the 244 here. You take out your NIS, which is 1466 here, which we had worked out up here. So you take it out because that's allowable before you calculate the education tax. You take out your pension if you had any. In this case, I didn't have any, and you apply a rate of 2.25%. Now, when we do the calculation of pay slips, employees' pay, you will realize that the rates are different, right? The rates for self-employed are a bit higher. NIS, I think, is 3% for the employee. And then for NHT now, it's 3% of the earnings for a year. So at the end of the day, Mr. Brown will have to pay 27,131.72 in statutory obligation. They say don't call it tax, right? Because NIS is not considered a tax, neither education tax. They say they are contributions, or NHG, they are contributions. So we're just saying statutory obligations. So he would need to pay 27,131.72 to the tax. Is that clear?
Ma'am.
Yeah.
That's still tax, but I understand them and their semantics.
And
I understand their semantics, but it's still tax.
all right, we're going to look at one for Mr. Brown if he earns $3.1 million as profit. Right? Let me use my spreadsheet to see if I can better walk you, if you can see what I'm doing. So this was Mr. Brown at 224. So this is Mr. Brown at, let me see if I can make it bigger. You can see it? Big enough? Just to 2024. So this is just my worksheet, right? So Mr. Brown here, I'm using an earning for him for $3.1 million, right? So it is going to be 6% of the 3.1 million. Remember the maximum of $5 million. So if it were $5 million, if he were over $5 million, he would just pay the flat 300,000, right? Because he's below, the 6% is on what he has as revenue here, right? And note that it is actually on the income. Then when we get to the tax now, the income tax. My screen is right. When we get to the income tax now, we use the taxable income. So just pay attention to the term. What does it mean by taxable income? Taxable income is just the income on which the tax is going to be calculated, right? And the taxable income is found after you have taken out the threshold, because remember, the threshold is something that you must get, right? The government is not charging you tax on all that you earn, they are giving you an allowance, and so you pay your tax on the difference. Now, for our purposes, we also have the NIS as an allowance, right? So we take out the threshold as well as the NIS from the, oops, come on. What are you doing? From the profit, and you get 1236. It is on this figure that we calculate the 25%. So if I just go equal to this times 0.25, you get that figure, right? So it's a 25% on your taxable income, and your taxable income is your profit or your income or your gains, whatever you call it. Get allowance for the threshold, you get allowance for the NIS. If you had pension, you take out the pension, and it is on that that you calculate the 25%, right? For the education tax, I see I have the rates over here. For the education tax, you take the income, sorry, you minus your NIS, and then you apply 2.25%. And for your NHT, it's on your straight income that you apply 3%. So at the end of the day, you owe, on your $3 million, you owe TAJ $660,000. 315 of it is for income tax or PAYE. 186 is for NIS. 65 is for education tax, and $93,000 is for NHT. Is that clear?
Yes, miss.
I'm all good to go.
Right, so this is what you would need to pay over to the statutory body, and you know that is due. They give you, after the end of the year, you have what, 3 months, that you pay it in March. So they give you a moment to calculate it and a moment to pay it over. Now, what they also have is that they do what you call, so you would do this on what you call a SO4 form. As a self-employed person, you use a SO4 form where you would state all your income and so on. The system calculates it for you, but I always like to do it manually, because there are times when they make changes to the system and there's an error. So you may have to call them and they tell you, okay, put it here or put it there in order to get what it's supposed to be. So I always like to have a manual calculation so I can match what the system is showing me. Right? So this calculation is a good to have. So you can check to see if your taxes are being calculated properly. All right. As I say, you have good resources there at the tax office. You can find where if you have an issue, if you are doing the calculation and you have a problem, that you can call to talk to them. Tax office does not like to give you back money. So if after you work out your tax and you find that, let us say you pay too much and whatever, and you try to get it back from them, they don't like to give you back. They will want to come and audit your books before they give it back to you. So it's probably a good thing for you to ensure that it's done properly so that you don't overpay and can't get it back. All right. Because as I say, when they decide to come, they might come and see things that you never saw, and then you end up having to pay more tax again. So try to get it done properly at the first time than having to go through it a second time. All right. And I'm moving today. So let us see. All right, so You want to work one out for yourself? Are you in a position to work? I know you're all looking at the screen, but can you work?
You're gonna give us the spreadsheet with it. We have the formulas, or we're going to work it out our head, miss.
You want the spreadsheet with the formula? But see this, see it here on the screen? All right, so look on the screen, and I'm giving you, let me see, I'm giving you 5 minutes to work on 4.85 million.
Is the profit?
Yes. So 4.85 million, try and work that out.
Make it still, I can see it. All right. The profit gain is 4.85 million.
I'm not hearing you, so if you're talking to me, I'm not sure what
Yeah, I was just working it out in my head.
Oh, okay.
I
I
didn't
just wanted
realize
to
I
know.
was a mute.
What did I say? 4.85?
4.85 is the profit or income.
Right. Oh, okay.
Sorry, is that 4.85?
4.85, yeah, 4.85.
Thank you. Thank you.
No, I want to change it. I'm going to change it. So let us go 5.2. All right, I'm changing it. Did we hear that? Because I want to show you something. Hello?
Yes, miss.
I'm changing to 5.2.
Yes, miss.
Okay.
And just to confirm, that's 5.3 million, right? Not 5.2?
5.2.
Okay.
And you're seeing the formula, right?
Miss, you sent us the spreadsheet?
Oh, can you see it from the screen? I don't know how to.
I don't think I
Let me
can
see if I
see
can.
the formula.
Wait, let me see if I can send it to you in the group. Hold on.
Personal income tax threshold is.
Hold on a minute.
But 25% of your money is a lot of money, you know.
Hmm?
You can imagine those who are paying tithes at church pay 10% and then 25% for tax, 35% of your income.
So let me, where's my screen?
Mister, you need the amount of money for the percentage for the 5.2 million, miss.
I want you to do it like how I showed it to you on the screen. So I want to know what the tax is, what the income tax is, what the NIS and NHT and so on. I want to know what all of them are. So look on the screen, you're going to try and calculate it just as I did. I'm trying to attach the spreadsheet for you, but hold on. Why are you? See that? Sorry, this thing don't want to cooperate. Cooperate with me, cooperate with me. All right, here goes again. Matthew? I don't hear Matthew. All right.
Miss, the income tax threshold, that have 1,650,000. How did we get that again?
All right, so remember that we were working on 1.5 before. The government had given us 1.5, and then they gave us 1.7. So because of the time that it was given to us, we have to prorate it.
I think it was 1.8.
So there's the first 3 months where we were still under the 1.5, and from October, April going down to December, we were under 1.7. So it's the average of those 12 months. 3 at 1.5. I remember it's the 1.5 is for the year. So it's, I think it was what, 125,008 per month, and it went to 141 or something like that. Yeah, 141,674 as of April per month. And it was 125,008 from January to March. So if you look on it, I just sent you the file. If you look on the tab that says self-employed John Brown 244K, you will see what the threshold was per month.
Boy, miss.
You see?
Hold on. Oh, there are more than tabs. I wasn't on the right tab. Is self-employed John Brown 3.1 that tab?
Say that again.
The tab that we should be on is self-employed John Brown 3.1 million.
Right, 3.1 was the one we worked out just a while ago. So I just sent it to you for guidance. 244, that one with 244 has the threshold on it. Where you were asking?
Oh, the 244.
Yeah, that shows it per month. So we were under 1.5 from January to March. So 23, 24, the year 23, 24, we were under 1.5. And then in April of 2024, the threshold was increased to 1.7 million. So those figures that you see in column M, those are what the threshold would be per month. So if you have a monthly, if you're paying or calculating whatever it is monthly, then it would be those figures we use. This one that we're doing, we're using it for the year. So that's why we use the 1650, which is an average of all those 12 months.
Okay.
Tell me when you're ready. All right, so let's look at it. Which one was that again? We were doing 5.2. We're ready?
Yeah, we were doing 5.2.
All right. So,
my strong
and-
area. So while we're going through it again this time is when I think it will really sing for me. Let me just declare that up.
I don't know, you're very low now, you see,
I
Tanisha.
don't know what is happening.
You're low, boy. All right, say that again. What you saying? Abiathar? It's me and you and Tanisha, right? Because
Tanisha or Tishana?
oh Lord, Tishana. So it's Tishana and Abiathar. I don't know, Matthew, go and leave us. Not hearing him at all. All right, so it's just the three of us working this through. I hope the others, if you're on, you can follow. All right, so you ready now? You have something, Abiathar, you have something? You're able to do anything?
No, miss, the computer started to even reboot itself, telling me about some update, miss.
Okay, all right, so you're back now?
Yes, miss, I am up and running now, miss.
Okay, all right, so let's look at it. All right, so I'm just going to ask you before I put it on the screen. All right, so we start out with the profit of the 5.2. What is the income tax threshold? So Tishana, are you going to talk out. You hear? You're going to do the talking.
Read it, miss.
Yeah, man. Tell me, and then we work through. My throat tired. Let me drink something.
We can drink some water. All right. So the income tax threshold, what should I say? The amount?
Yeah, start from the top, like what we did it on the sheet. So you can use the sheet on the screen as your reference.
So the income tax threshold, the 1,650 and 90. What should I tell you? How to work it out? What am I saying?
Yeah, man, start from the top. So you're going to tell me the profit for the period is at 5.2. Take out the threshold of whatever, less the NIS, whatever, give me the taxable
Right.
income. Similar to how I have it on
So
this.
I'm just walking through what is there.
Yeah, you're walking through what you should have for the 5.2.
Okay. So the profit for the period is $5.2 million. Less the income tax threshold, which works out to be 1,650,090. Less the NIS, which is 300,000.
Nice.
So the
That's
total.
where I wanted to trick you.
No, is that trick? So in less the NIS and then the total taxable is 3.2. No?
Yeah. But where are you seeing that? You worked it out, right?
No, I didn't work it out.
Where you saw that?
In
You're
the
seeing my
sheet.
screen?
Seeing your screen? No, I was looking at my screen.
Oh, you saw the sheet in the screen, in the sheet.
In the sheet.
Okay. So you're seeing You're seeing the workings for the 5.2
Yes.
in the sheet that I sent you.
In the sheet that you sent, yeah. It
Okay.
wrong.
Okay. No, I was trying to hide the sheet, right? Because I wanted you to work it out yourself. And then we compare the answers. But I didn't realize. So I put the
You give us the
NIS.
answer?
Yeah?
Miss, I
What?
try to work it out, miss, and I don't get the change it out that I hear you guys talking about.
So, and I moved from 4.85 to 5.2 because I wanted you to remember. You remember that I said the maximum you can pay on NIS is 300,000, which is actually 6% of 5 million. Yes. So if you earn more than 5 million, you don't use the 6% times 5.2. It is 6% times 5 million. That's the maximum you can pay. You can't pay nothing more than that. So that's why I went to 5.2.
Oh, that is a trick.
Yes, but I end up giving you the answer. Oh, Lordy. Okay. All right. So, yes. So you can tell me, since you have it in front of you, you can tell me, since I'm not projected on the screen. So you can go ahead. Which other thing didn't you get, Abiathar? Well, you wouldn't have got the income tax if you had the wrong NIS. Right?
Miss, for the less NIS, I got 186,000, miss, and this is a fixed maximum amount that isn't for income tax purposes, miss.
Yeah, you got 186 because you multiplied the 5.2 times what did you do? How did you get the 180 whatever? How did you get that? Because even if you you multiply by the 5.2, you wouldn't get that. So how did you get the 186? What are you looking at? The one on the screen right now is for 3.1. That's what you're looking at?
Yes, miss.
But I gave you the one for 5.2. So tell me now how you got that. Tell me, let me know which part of it mix you up, confuse you. Tell me which part confused you. Remember, you're working on 5.2, not the 3.1 that I have on the screen. You're doing 5.2. So you're supposed to be working one out for yourself.
Yes, miss. What I have, miss, is 6% of 5 million of the 5.2, miss, equals 0.6, miss.
Huh? Come again.
Sorry, I was to say 6% of the 5.2, miss, would be equal to around 312,000, miss.
Right. But what is the note beside it saying? What is the note beside it saying? On the screen, oh, I'm putting it back on the screen. On the screen, we have 186. What is the note beside it saying? You seen it? I'm amending it a bit, hold on. You are seeing the screen? It says maximum of 5 million times 6%. That's the maximum you can pay. So if you have $5.2 million or 5.1 or 5.05 million, you can only pay 6% of 5 million. That's the maximum you can pay. So if your earnings is below 5 million, then it's going to be 6% of whatever the earnings is. But as long as you reach over 5 million, you stop at 300,000. Right? You get that?
Yes, miss, definitely, miss.
Right. So in this case, the NIS would be 300,000 because that's the maximum he can pay. He cannot pay 312,000, which is what we would get if we multiply it by the 5.2 by the 6%. All right, Tishana, continue. So we were at NIS now. Tell me about PAYE. Tishana?
Sorry, me there you're talking on and on without realize my mic wasn't open.
Okay.
Okay, so the NIS, okay, so we've confirmed that maximum is 6% at $5 million, so we don't pay the 12, we would say.
Right.
All right, so PAYE now is 25% of our taxable income, which is 3,249,910. So 12
So talk us through taxable income.
taxable income is the income less income tax and NIS.
Not income tax. The threshold.
Right, how do I put that? So the
income tax
threshold that is taxable. How do I say that?
The threshold that below which you don't pay tax on. So it's a threshold. So it's the income tax threshold, right? And the NIS that you subtract from your profits or your income to get your taxable income. That is what the tax is going to be paid on. I remember I was saying to you that we call education tax NHT, NIS, and so we call them tax. But revenue will tell you that it's not tax, it's a contribution. Right? So when you hear they talk about tax threshold, it's really the income tax threshold they're talking about.
So we're paying tax on the threshold below
No, anything below 1.65, you
we
don't
don't pay tax.
Right,
So the amount earned above the tax threshold is what we're paying.
correct. The tax
So the
threshold and
amount
the
earned
NIS.
above the tax threshold less the NIS amount is what is the taxable income.
Right, so it's a 3.2 here now. So we're paying the 25% on the
Okay,
3.
but I'm glad we went through that because that helps me to understand that is the amount above the tax threshold less the amount for NIS, that becomes the taxable income.
Correct,
And that's what we're paying 25% of.
correct. So if you earn $1.5 million in profit,
Yeah,
when you apply that threshold to it, only 100,000 you're gonna pay tax on.
right.
Mhm.
So it's only the,
So as long as you go above
but
that
we will take out
threshold,
the NIS amount out of it as well,
right, to calculate the tax.
the
The
taxable
tax
income.
due.
What a heap of strangling of my brain. Okay, all right.
Well, the good thing is that you can do it online, but as I say, and I highly recommend, try to know how to calculate it for yourself, because if there's an
Right.
error, you can pick it up.
Yeah.
Mhm.
All right. So we're gonna pay 25% then of that taxable income, which is 3.2 million, and
Mhm.
that's 812 for 7750.
Mhm.
And then for education tax now, it's income minus NIS.
You can point the cursor in the space, and you'll see where I'm taking the figure from.
The cursor in, hold on.
The Excel sheet, just move the cursor down there, and you will see where I'm taking the figure from.
H6 minus H12.
Right. So look what H6 is. You're
H6,
following us, Abiathar?
5.2 million.
Yes, Miss.
Mhm.
All right, so H6 is the 5.2, which is the total profit before you
Right.
okay, minus the NIS amount,
Which is in H12.
which is in H12,
Mhm.
and then
Tishana,
25% of that.
it's not 25%,
Wait, how much percent?
2.25%.
All right, 2.25.
Mhm.
Oh, so it's 2.25% of your total profit minus your NIS that
Mhm.
they tax to get the education tax.
That's your education tax contribution, yes.
Right, Miss. That's what I got, Miss.
Okay,
Yeah,
great.
yeah. Mhm.
Mhm.
So that's clear. And then the income now for the NHT,
Mhm.
it's 3% of the total profit, not the
Right.
not the
Not
taxable
the taxable
income.
income, right? Taxable income is just what you pay tax on.
Okay. It's the
Yeah.
first time in my life I ever sit down to get a full understanding of this thing.
Mhm.
Yeah. That is very clear now, miss.
Okay. Abiathar, is it clear to you too?
Yes, Miss. I'm tagging along with.
Sure, that's so uncertain.
Eh?
Yeah. It took a
Okay.
lot of effort for me to understand it, but now I really understand. So I
And you
appreciate
have the sheet, so you
the struggle.
can follow, because I didn't type hard type in there. I just use the formulas. So you can see the cells, right? Just go to so if you go in the cell, just go to the end of the cell and just press the cursor, and it will just highlight the cell that it is coming from.
Miss, could you please send back the worksheet, Miss? I lost it because I lost the connection.
Hold on, and where am I? So let me just send back the worksheet. Can I forward this thing? No. Alright, copy. Let me see if I can copy and paste. No, it is currently in use, so it doesn't allow me to do that. Okay, let me close it. You're able to see the cells that the file, the information is coming from, Tanisha? Tishana, I keep calling the Tanisha boy.
Yes, miss?
You're able to see the cells that the formula is coming from, right?
Yes, ma'am. When I click on it, it highlights the cells.
Yeah. Mhm.
Yeah. Thank you.
All right, there you go, Abiathar. Abiathar, what do they
Thank you,
call
miss.
you? Do you have a shortened name? They call you Abby?
Nita or on this platform they call me Abby, Mr. Abby.
Okay. You know, I saw your name in the Bible. I was wondering where you got that name from. And I think the same day that we started class, I saw your name in the Bible. I'm like, okay. All right. Okay, so that was it for calculation of statutory liabilities. How do you calculate your taxes? And you see, the entire thing is a walkthrough from where you start with your source documents, you enter the information in the system, you get your general ledger details, you get your trial balance, you do your financial statements. From your financial statements, you know if you're making a profit or a loss, and it is from that figure that you plug into your calculation of personal tax, and you work out to see what is due to the government. Now, if you keep a track of that, you won't have to wait until when March 1 come and you start to get frustrated because you don't know what you made and you never record your costs and so on. But if you keep abreast of it and you sit and work out your tax, then you will have an idea where you are. Okay, the tax office also wants you to do what they call an estimated tax. So each month when you file your tax for the previous year, which we call SO4, when you file that, you are also required to do a SO4A, which is an estimate for the following year, right? So
That
persons,
chop off my neck, wicked Miss Karen.
what the estimate?
Yes, ma'am, because the next month, the next tax term, they figure when me come in and them a text me down, say me owe them that amount of money, miss me. Can't wait for the tax person come in.
No, but how, so remember, so did you file your initial tax?
No, miss, I was just new to everything, miss, and went down there and told them that I closed the business and so on and so forth, miss, and I was explaining what is happening with the business and so on, miss, and they told me to file an estimate, and then like they say, since that year is already gone, file an estimate, and I file an estimate, and then I think they billed me according to the estimate.
Of course. So what did you put on the estimate? You see, and that is the thing, you know.
I put say me I gonna make around 200,000 for the year,
Ah,
miss.
oh boy.
And let me tell you,
But see,
the people are
you just work out a tax on 200,000 here. So they, how you end up, oh, they do it per year.
yes, miss.
Oh, okay. Because at 200,000, you wouldn't have to pay income tax. You wouldn't have to pay PAYE. But I
Right.
guess
I only would have to contribute
do the
art,
other
something called
contributions.
heart and NHT and NIS and all of these stuff. And I was explaining to them that do I really need to pay that amount of money even though I don't have any employees and we're not, because people think that two people are dying. So should we say we have the highest death per 100 people in the Caribbean here as a country, small country. So people think that we are making this lump sum of money, and because they don't have any eyes into the book. And now you're teaching me to give them eyes into the books, I hope that will change, because trust me, the tax that they're telling me that we owe is bigger than what we are making.
So, and this is now how you will have to prove it, because they are going to say to you, prove it. That's the problem, you know. They are going to say to you, now prove it. But I don't understand though, Abiathar, because they were giving amnesty the other day. Didn't you try and get amnesty? When they were writing off monies off books, if you pay what and whatever, did you go to them?
No, miss. Miss,
You allow the time to pass? Because I think the time passed. They were just giving some amnesty or something. That
no,
if you
miss,
pay
I wasn't
current, they
aware of
would
that, miss.
forgive. Oh, what? Oh, dear. All right. Anyway, I guess when the tax person comes, you can, hopefully you can have a good conversation.
True, miss.